Hello, hello, hello. Hello, Zanam, Anil here. Zanam, who is the presenter there? Have you sent them? Yeah. नहीं नहीं लेकिन have you sent any kind of mail to someone else as well? Actually यार किसी और को भी भेजा हुआ है Pristine support करके and it's showing your email ID. Zanam at एक क्लिक किया ना ठीक है ओके 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 बाय बाय हेलो। हाँ प्रसाद, ये ना मेरा वेबिनार था 5 बजे, ये इसमें कोई सपोर्ट भी है क्या? कुछ पता है? यार मैं एक्चुअली विजर्स ने लिंक भेजा था, तो मैं पैनलिस्ट में दिख रहा हूँ। तो दूसरे, तो उसको मुझे कन्वर्ट। हाँ तो समझ गए ना आप? हाँ, उसको जल्दी बना दो। ओके। Hi, good evening, friends. Am I audible? Am I audible, friends? Please type in the chat box. Okay, okay. So tell me about the voice quality. Is it okay? Should I increase, decrease the volume? All right. Okay. Okay, fine. All right. Thank you. So guys, let us wait for another 2 minutes and then we'll start the session. Okay, just for another 2 minutes. Hi friends, this is Anil and today we are going to start with the basic session on bond valuation. Okay, so this is going to be a very rudimentary session in which we'll talk about what a bond is and how to price a bond and what are the effects of various parameters on the bond price. Alright, so you can type in all your queries in the chat box or the question box. Alright, and if you have any particular query that you would like me to talk about, okay, that is not related to this part of the session, we can talk towards the end of the session. Alright, so let us start with the session today. So when I talk about a bond, so let us see what a bond is, okay, and let us see what are the various terminologies related to bond. So suppose there is a company, okay, so company ABC. So company ABC wants to set up some kind of factory here. Okay, so this is a factory. And for this factory, they need a capex of say $100 million. Okay, so they need a funding of $100 million. So this is $100 million. Now, this ABC company wants to raise this complete money in the form of debt. They want to borrow this money. So they want to borrow this money. Okay, so borrow this $100 million. Okay, from various investors. All right. So what they do, they ask for these $100 million from various investors So what they have done, they have divided this $100 million into 10 million papers. Okay, so this is 10 million papers. So 10 million papers, so which means that every paper, so every one paper is equivalent to $10. So if as an investor, you have bought one paper, that means you have lent how much? $10. Okay, fine. So these investors, they give $100 million to the company today. Okay, and in lieu of this, ABC company pays some interest on this, say 10% interest on this, which is say annual interest of 10% on this $100 million. Okay, so let us assume that the market rate is also 10%. So in market interest rate is also 10%. Okay, so this ABC company, every year they would need to pay 10% on this borrowed amount. Okay, and after the stipulated period, say after 10 years, ABC company will also pay this principal amount of $100 million back to the investors. Okay, so if we see the complete cash flow, so it is like this. So initially, investors will pay $100 million, but at every year, say this is year 1, year 2, year 3, and so on, and this is year 10. So every year they will receive 10% of this 100, so which is say $10 million. Okay, and at the maturity they will also receive this $10 million plus the principal amount of this $100. So this becomes $110. Okay, so this is the basic cash flow exchange problem, right? So here the person who has borrowed the money, they are called as the issuer of the bond. Okay, so ABC company is the issuer of bond, which means they have borrowed the money. Okay, this 10% interest rate that is paid annually, this is called as coupon. Okay, so this is called as coupon rate. This 10 years, when the principal payment is repaid, that 10 year is called as the maturity of the bond. And this market interest rate is nothing but the market interest rate. Alright, so this is the simple case. Okay, so then let us go back here. So here this $100 is the initial amount received by the company or the issuer, and this is the amount paid by the issuer. And for an investor, this is the initial cash outflow, and these are the cash inflows for the future. Okay, now if we have to value this cash flow problem, it is a simple time value of money problem, right? But before we move to the valuation part of this, let us see the valuation in general. So if I have to talk about valuation in general, so valuation in general always consists of three parts. Okay, so this is valid for any kind of valuation you can think of. So the first part is the cash flow to the investor. The second part is what is the expectation of the investor. Okay, and the last part is the time value of the cash flow. Okay, so when I talk about this cash flow, okay, for a bond investor, this is the cash flow available, right? If I talk about expectation, we need to see what is the expectation of the investor, bond investor. And if I talk about time value of the cash, that means that any investor would value a cash flow earlier than later. So it means I would value $1 today better than $1 tomorrow. All right. So in any kind of valuation, there are only three components. One is the cash flow, and it's only the cash flow, expectation of the investor, and the time value of the cash flow. All right. So whenever we are doing valuation in general of any kind of instrument, there are only three things required: cash flow, expectation, and the time value of the cash flow. So depending on different expectations, the valuation might change. Okay, so you might see the valuation of some products are different when we change the investor. Okay, the only thing that's changing is the expectation. So a person with a higher expectation may value a product lower than a person with a lower expectation. All right. So now, since we have got the cash flow, we know the expectation of the investor, we can find the value of the cash flow stream or the cash flow from the security. Okay, so let us see a small exercise here. Okay, so here we have different parameters associated with bond. Okay, so here we assumed in this scenario, we have assumed that the market rate was 10%. Okay, and we have assumed that the coupon is also 10%. So coupon is this 10. So what happens in this complete scenario is that whenever our investor has bought a particular security, okay, so this was the broader picture. So this picture that we have seen, that is the broader picture for the complete company. Now if I have to talk about one single investor, for the case of one single investor, suppose he has bought one paper, okay, only one paper, or say 10 papers. Okay, now what will happen, that at the maturity t equal to 10 years, this investor has to pay, so as I said, one paper is equivalent to $10, so he would have to pay $100. Okay, he would have to repay this $100. Now this $100 is assumed as constant, so this is some notional value, so this is not the actual amount that the company is going to receive today. Okay, so in the previous case we have assumed that this $100 is the actual amount that the company would receive today, but this is not the case in general. So in general we will assume that this $100 is some kind of notional amount that the investor has to repay at the maturity. Okay, so this we call as face value of the bond. Okay, or we say notional amount of the bond. or the notional value. Okay. And when I said the coupon is 10%, okay, coupon is 10%. So this coupon of 10% is calculated on the face value. Okay. So here $100 plus 10 would be the coupon payments. Okay. And similarly, the interest payments would be $10, and so on. So this is equal to 2, 1, and so on. Right? So the face value is some notional value of the bond on which the interest payments are calculated. Okay. So we always need to start from the notional value. So notional value is $100. If the notional value is $100, the coupon payment would be coupon percent into the notional value, which is $10. So this will give us the cash flow stream that the investor is going to receive in the future. So if this is the cash flow that the investor is going to receive in the future, what should be the amount he should pay today? So what is the amount he should pay today to the company? So that is nothing but the price of the bond. Okay. And this price would depend on the expectation of the investor, right? And if the investor's expectation changes, this price is going to change. Okay. So normally this expectation is nothing but the market yield or the yield to maturity of the bond. Okay. So this you can call it as yield to maturity of the bond or the interest rate in the market. Okay. Now to make it slightly simpler, so how to find the value of P is the game here. So to make it slightly simpler, I can ask you a simple question. So suppose I receive $10 today, okay? Say $10 and $110. So this is one. Second is, suppose I have invested $100 in my savings deposit and the interest rate on my deposit is 10%. What is the amount that I should receive after 1 year? So what is the amount I should receive after 1 year? Guys, I have invested $100 in a savings account today. The interest rate on my account is 10%. What is the amount that I should expect after 1 year? That's right, Sujit. That's correct, Helen. So the amount after 1 year would be 110, right? Now, if I ask you the same question, but in slightly different way. So if I ask you, if you are going to pay me $110 tomorrow or after 1 year, what is the amount I should pay you today? That would be $100, right? It's just the reverse of it. Similarly, somebody is ready to pay me $10 after 1 year and $110 after 2 years. What is the amount I should pay him today? So that is nothing but the present value of all the future cash flows. So that if I denote by minus P, so minus P is nothing but 10 upon 1 plus the expectation or the interest rate plus 110 upon 1 plus the interest rate raised to power 2. Correct? So if the interest rate in the market is 10%, price would be $100. Correct? Now similarly, instead of only 2 cash flows, we are having 10 cash flows, we need to find the value of this P here. Okay, so let us move to the Excel workbook here. So here we have all the parameters given to us, okay, and the parameter says that the notional amount is $100, the coupon percent is 10%, and the tenure of the bond is 10 years. Okay, now interest rate in the market, so this is the interest rate in the market. This is 6% throughout, okay, and I need to find the price of the bond. Okay, so all the parameters are given to us. So if the coupon percent is 10%, what would be the coupon payments every year? That would be notional amount into the coupon percent, that is $10, correct? Now, at every year, I need to pay $10 to the issuer. So I need to pay this $10 to the issuer for 10 years, correct? Now, at the maturity, that is at year 10, I need to pay the notional amount as well, correct? I need to pay the notional amount as well. So the total cash flow would be this, right? So this would be the cash flow stream. Now, if this is the cash flow stream, I need to find the present value of all these future cash flows. Okay, so if the interest rate in the market is 6%, okay, what would be the discount factor here? The discount factor would be 1 upon 1 plus the interest rate raised to power number of years. Okay, so the discount factor for the cash flow in the year 1 would be 1 upon 1 plus 6% raised to power 1, right? So that discount factor would be 0.94, and this would keep on changing, right? Now, if these are the discount factors, what would be the present value? Present value would be the discount factor into the cash flow. So what is the meaning of 61 here? The meaning of 61 here is that these $110 after 10 years are equivalent to $61 today. Okay? Or if I ask you what's the meaning of 0.94 here, the meaning of 0.94 here is that $1 after 1 year is equivalent to $0.94 today. And similarly, $0.1 after 2 years is equivalent to $0.89 today. Okay. So what would be the price of the bond? The price of the bond would be sum of all the discounted future values. Right. So this is the basic exercise on the calculation of price of fixed rate bond. Now I want to see the sensitivity of this price with respect to different parameters. Okay. So I would like to make this model slightly flexible. Okay. So if I change this tenure of the bond to 5 years, all the cash flow should automatically be placed. Okay. So I should write the formula in such a way that this $100 goes here, and after this 5 year, all the cash flow should have been 0. Okay. So I need to make this model slightly flexible. For that, I'm building some flags here. Okay. So say this is coupon payment flag, and I have a face value or the maturity flag. Okay. So here coupon payment flag is that if this year is less than equal to the maturity, okay, give me true. So either you can write a if statement here, if this is less than equal to tenure, give me 1, otherwise give me 0. Or you could have simply written this and simply multiplied it with 1. Okay, so it will give you 1 on 0. So wherever you are getting a 1, it means you need to have this cash flow, and wherever you are getting 0, you need not to have the coupon cash flows. Okay, and similarly for the maturity of the bond, if the year is equal to the tenure of the bond, you get 1, otherwise you get 0. So what I need to do here is I need to simply multiply this coupon with the coupon payment flag. Okay, and similarly in the case of notional amount, I need to multiply it with the maturity of the bond flag. So whenever maturity is reached, this notional amount will get multiplied by 1, otherwise it will get multiplied by 0. Okay, fine. So now this model is slightly flexible. So now if I change it to 10 years, all the cash flows will get placed. Fine. Now let us see the sensitivity of this price with respect to the various parameters. Okay, so before we go to the Excel, let us see what happens in theory. So now if I generalize this cash flow problem, okay, so I have minus P, which is the price of the bond. This is not the notional value, this is the price of the bond. Here I have the coupon payments, okay, coupon payments and so on, and at the maturity, that is at T equal to capital T, I have the face value or the notional value plus the coupon payments, correct? And I can say that the price is nothing but summation of the cash or the coupons upon 1 plus yield to maturity raised to power I, where I varies from 1 to time to maturity T, plus the face value upon 1 plus Y raised to power capital T. Correct? This is the case here. Now I want to see the effect of coupon on the price. Okay, so if I increase the coupon, the price increases, right? So if C increases, this implies that price of the bond increases, and if I increase this yield to maturity, the price is going to decrease. So if yield to maturity increases, this implies the price is going to decrease. Correct? Now also we have seen the effect of coupon and the yield to maturity. If you remember, we have seen that when coupon was 10%, okay, and the yield to maturity was 10%, the price was 100. Similarly, the notional amount of the face value was also 100. Okay, so here we can say, also from this particular equation, we can say that whenever the coupon is equal to the yield to maturity, the price is equal to the notional amount or the face value of the bond. Okay, so these kind of bonds are called as par bonds. Okay, now if this is the case, here, whenever C is equal to the yield to maturity, the price is equal to the face value of the bond. If I increase C, which is at the numerator, okay, at the numerator, so if I increase C, that is C is greater than the yield to maturity, the price would be greater than the face value because the numerator is increasing vis-a-vis this Y, correct? So the price would be greater than the notional value or the face value. Okay, so these kind of bonds are called as premium bonds. Okay, and similarly, if I decrease C vis-a-vis this yield to maturity Y, the price, because the numerator is comparatively lower than the denominator, so price would be lower than the face value, and these bonds are called as discount bonds. So when the price is greater than the face value, we call those bonds as premium bonds. When the price is less than the face value, we call them as discount bonds. And when the price is equal to the face value, we call them as par value bonds. Okay. Now, let us go back to the Excel and see what kind of bond this is. So here we have seen that the coupon is 10% and the yield is 6% in the market and the price is 129. Okay. So here the case is that coupon C is greater than yield to maturity Y, which we know implies that the price should be greater than the face value. So here the price is $129.44 and the notional value is $100. Right? So now if I exchange these values, so if I simply exchange these values here, if I exchange these values, so this is say 6% and this is say 10%. Now the price is less than the notional value, which means it's a discount bond now. Correct? And when this is also 10%, this is also 10%, the price is equal to the notional value. So these kind of bonds are par value bonds. Right? Now let us see the effect of these parameters, okay, on the price of the bond. For that, I'm going to run a Excel tool called as data tables. So here I'll build this data table in this format. So suppose I want to see the effect of the price of the bond with respect to the coupon and the interest rate. So I'll build this kind of rectangular table. Okay, so on the column side I have the interest rate, that is this yield to maturity, and on the row side I have the coupon. So at the intersection of the row and the column I have this price. I link it to this price. Okay, so I'll select this complete table. I'll go to data, what if analysis, and data table. Okay, and I'll link these row input cell and the column input cell to the corresponding assumptions. So row input cell is what? Coupon percentage. So I link it to coupon percentage, and the column input cell is nothing but the yield to maturity. I link it here. Okay, so now these values are nothing but the prices corresponding to a particular coupon and the yield to maturity combination. Okay, now if you see this particular line here, the interest rate is fixed, which is 2%, yield to maturity is fixed, but the coupon is increasing. Okay, and if you notice, this coupon is greater than the interest rate. So when the coupon was 2% and the yield to maturity was 2%, the price was equal to $100. And when the coupon is increasing, okay, when the coupon is increasing, the price of the bond is also increasing. So here you can make a chart and see. So as the coupon increases, the price of the bond also increases. Okay. Similarly, now if you fix this coupon as 2% and increase the yield to maturity, you will see that the price of the bond decreases. Okay, so here this is this is the relationship between yield to maturity and the price when the coupon is fixed. Okay, and this is the inverse relationship, right? So the idea is whenever coupon is greater than the yield to maturity, the price is greater than the face value, and when you increase the coupon, the price also increases. Okay, and when the yield to maturity increases, the price decreases. All right. So this is one relationship that we should keep in mind. The another relationship is very, very important, and that is between the price of the bond and the time to maturity. Okay. So roughly, let us see. Now, please keep an eye here. So let me bring it back to 6%. Okay. So here the price is $129. Okay. And the tenure is 10 years. Now, if you decrease the tenure to 8 years, the price has gone down from 129 to 124. If you decrease it further, 5, it has gone below 120. If you still decrease it to 3, it keeps on decreasing. So what is happening here? So the price is decreasing as the time to maturity is decreasing, right? Now please remember that here the coupon is greater than the yield to maturity. That this is the case for the premium bonds. Now if I reverse this scenario, okay, and bring it back to 10%. Now for a discount bond, the price is 75, correct? Now if I decrease the time to maturity in the similar fashion, 8, now the prices are going up. 5, prices are going again up. 3, it has gone to 90. Now what is happening? So in the case of premium bonds, the price was decreasing as the time to maturity was decreasing. Okay, and in the case of discount bonds, the prices are increasing as the time to maturity is decreasing. All right. So let me note it down here. So here, suppose this is the face value of the bond, and our bond was like this, somewhere priced here, and the discount bond is priced here. Okay, and this is for the time to maturity of 10 years. Okay, so what is happening? As the time to maturity is decreasing, this bond is also decreasing, and as the time to maturity is decreasing for a discount bond, the prices are increasing. So what's happening here? For the premium bonds, the prices are decreasing as the time to maturity is decreasing. So this you can say as T. And the prices are increasing for the discount bonds as the time to maturity is decreasing. So this particular concept is called as pull to par, which means that as the time to maturity decreases, the bonds tend towards the face value of the bond or the notional value of the bond, and at the maturity, the price of the bond is nothing but the face value of the bond. Okay, so this concept is called pull to par, where bonds tend toward the face value of the bond as the time to maturity decreases. Okay, so let us go back to the exercise here. Now if I build a similar kind of data table where I change the time to maturity, okay, so this is 1 year, 2 years, till 10 years. Here I have the price of the bond, okay, and here I run a data table. This is only a column data table, so I link it to this tenure, and this is the case here. So this is the case for a discount bond, correct? So this is the case for a discount bond, And if I change this to a premium bond, so if you see this, so this is for the discount bond. So par value is what, $100 here, correct? So this is the $100 line. So this $100 line, this bond is approaching towards $100, right, as the time to maturity decreases. So when the time to maturity was $10, this was the difference between $100 and this particular price. As the time to maturity decreases, this difference is decreasing. So in effect, the bond is tending towards the par value of the bond. Now, if I change it to a premium bond, say this is 6%. So here $10 is here. This was the premium bond. It is now decreasing. So it is tending towards $100. Okay. Now I want to see. I don't want to change it again and again. So this is a kind of Excel exercise. So we will build a kind of GUI where you can change the bond without changing these numbers. Okay. So here I have an option for discount bond, discount, this is premium, okay, and this is for par, okay. Okay, so here I go to this developer tab, okay, I choose this combo box in the form controls, okay, I build this combo box. Format control, input range is this discount, premium, or par. Actually, we need only discount or premium bonds. That's fine. And say I link it to this particular cell. Okay. So here now I will have a list. Okay. And depending on what I choose from this list, I will get 1, 2, or 3. Okay. So this is the output that I've selected here. Okay. Guys, give me 2 seconds, please. Guys, so see here, depending on the relative position of these discount, premium, or par in this array, I will get the corresponding position. So premium is placed at the second position, right? Premium is placed in the second position, and par is placed in the third position. So I will get 3 here. Okay, fine. So now, depending on this, I will choose the coupon payment, or I can write some kind of formula here. So here I'll write a simple if condition. If, say, in the case of discount, I need it to be 6%. So if this particular value is equal to 1, then give me 6%. Otherwise, give me 10% only. Okay. In the case of par and premium, I need 10% only. Fine. Similarly here, I want to write a similar kind of formula that in the case of discount, in the case of premium, sorry, give me 10%. Sorry, in this case, give me 6% only. Otherwise, give me 10%. Okay. So here, %. Okay, and I need to write a slightly bigger equation. So okay, let us write a nested if. So if it is discount, which means it is 1, okay, I would need what? I would need a 10% value, right? I need a 10% value, and again if this is equal to 2, which is premium, I would need 6%, and if it is something else, then I would need 10%. Correct? In the case of par, I'm getting 10%. In the case of discount, I'm getting a discount bond, and in the case of premium, I'm getting a premium bond. Right, guys? So here I'll place it here. Now you can, and I will hide this. I can hide this using different measures. So one is I fill it with white color, but when you select this, again it's visible, so I can custom format it. Okay, so there are a lot of ways. So here, if I select discount bonds, now see what is happening here. So this is the premium bond, right? I want to see the discount bond. So here, this is the discount bond. So if I fix the axis, say the maximum to say 140, okay. So now you would be able to see the effect here, right? Now for a premium bond, the value is decreasing, and for the discount bond, the value is increasing as the time to maturity is decreasing. Correct? So this particular concept is called as pull to par concept. Okay. So now guys, you're free to post your questions. So wherever, I hope you have understood this part, but if you haven't, feel free to write a question on the chat box. Okay, so I'm reading question. Yes, you Sujit, you will get this Excel workbook. Yes, Arun, you can assume, say here. So guys, here Arun has posed a question. So he says, can we take a varying coupon for the bond? Definitely yes. So here, the only thing I need to do here is, so depending on how you are calculating your coupon percentage, you just need to insert another row, and depending on the parameter, okay, depending on the, okay guys, yes Siva, yes, okay, yeah. So depending on what parameter you are taking for the calculation of the coupon payment, okay, you can vary the coupon payments here, like I've did in the case of interest rate here, and you can calculate the coupon payment from there. Okay, does it answers, Arun? Okay, cool. So Harin is asking, the discount factor is the value of PV after n years. Not really. See, discount factor is nothing but, so if you have seen this equation, so we have assumed that 110 I'll get if I deposited $100 today, correct? So this, what is the discount factor? So how did you calculate this $100? $100 was 110 upon 1 plus 10% raised to power 1. Okay. So what is the discount factor assumed here? Discount factor here is 1 upon 1 plus 10% raised to power 1. So this is nothing but the discount factor, which means that discount factor is the equivalent amount of $1 invested or received after T period, which means in this case 0.91 discount factor means that it is the equivalent amount of $1 today that you are going to receive after 1 year. So if you get $1 after 1 year, it is equivalent to $0.91 today. So $1 after 1 year is equivalent to $0.91 today. Okay, got it, Harin? Please ask your question. Okay, so I've got a question that why we have assumed interest rates are constant. So here the interest rates are not constant. So actually this is just for the simplicity's sake that we are assuming the interest rate to be constant. Okay, so in reality the interest rates won't be constant. So here this interest rate 10%, this 10%, this is nothing but the average IRR, you can say. Okay, so this 10% is the average rate that you will get if you invest in this bond, assuming that all the intermediary cash flows are reinvested at the same rate. Yes, that's correct. So here we are assuming YTM is the interest rate. If we invest $1 today, then $0.9 is the value we get after 1 year, right? No, Harin, it's just the opposite. So if you invest $0.91 today, you will get $1 after 1 year. It's just the opposite. Okay. Is the plain vanilla coupon bond and zero coupon bonds the same? No, Arun. Zero coupon bond would be a bond where the coupon payment is 0%. Okay, so this is nothing but the zero coupon bond. Okay, so when compared to bonds, what is YTM? So if I got your question right, so see, what happens is that if you have a particular bond trading in the market, you would know the price of that particular bond, correct? So if you have a bond trading in the market, so you would know what is the price of the bond. Okay, this part is known to you. You would obviously know what are the characteristics of the bond, say the time to maturity, the coupon, okay, everything. So if all the components are known and you want to see what is the return from that particular bond, that is nothing but the yield to maturity. Okay, so if you have two bonds, one is trading at T1, the other bond is trading at say T2, okay, and one is having C1 and the time to maturity is T1 for bond 1. So you can calculate yield to maturity 1 here, right? And similarly T2 and C2, you can calculate the yield to maturity from here. From there you can compare these two bonds. Okay, so yield to maturity actually is a derived number. Okay, it's a derived number. So here we have assumed, okay, I'm getting a lot of questions now. Yes, Arun, you will get this workbook. Okay, Shiva is asking difference between zero coupon bond and a deep discount bond. See, zero coupon bond is a bond where you pay no coupons, okay, and a deep discount bond is a bond which is somewhere here, okay. So the difference between the price of the bond and the face value is huge, Okay, so why you are trying to compare these two bonds is that zero coupon bonds with a high maturity are nothing but deep discounted bonds. Okay, so although these two terms are not related, but these are associated. So zero coupon bonds normally with high maturity would be deep discounted. Okay, so yes, Arun, that's possible. Why would anybody offer coupon more than the market rate? Okay, so this is the normal confusion people have. So here guys, we need to see that no matter what the coupon is, no matter what the yield to maturity is, and no matter how different they are, in effect, the overall return is nothing but the yield to maturity. Okay, so let us assume, okay, two bonds here. Okay, so yield to maturity, say, or the interest in the market is 10% only. In one case, the coupon is 10%, and in the second bond, the coupon is, say, 20%. Okay, so you are asking that why somebody would offer this kind of a bond. So my logic here is that it does not matter, because if you see this particular bond, you're getting a cash flow of $10 here, $10 here, and at the maturity you have $110. But what would be the price here? The price would be $100, right? So you need to pay $100 upfront. But when you have this bond, you are going to receive $20 here. You're going to receive $20 and $120. But how much you need to pay here? You need to pay a huge amount here. Okay, so that would be, say, I don't know the exact number, but that would be say around $150. So initially you are paying 50% more than this amount. Okay, so if you are choosing this bond, so if you are paying more, obviously you should get more. So in effect, it does not matter how much coupon you are receiving. The only thing that matters is what is the yield to maturity on that bond. Okay. Is that fine? So it is used as a tool to pull more investors. Yes and no, both. See, guys, investors will never see the coupon here. They will never see the coupon. They will always see what is the yield to maturity. Okay, so the point that you guys are missing is this yield to maturity part. So this yield to maturity will define the return that the investor would receive. Okay, so no matter what is the price, no matter what are the future cash flows, what is the yield to maturity? This yield to maturity contains both this price and the future cash flow numbers. Okay, so depending on what is the yield to maturity, if the yield to maturity is 10% in this case, 10% in this case, an investor would be indifferent to any of these bonds. Okay. So investor would always see yield to maturity. Okay. So as I've explained here, yield to maturity is nothing but the return that you would get. Okay. Suppose a bond is trading at, say, minus $75. In the market today is trading at $75, and this bond is having a maturity of 5 years. Okay. Coupon payments are, say, $15 every year. Okay, $15 every year. And here at the maturity you will get $115. Now, what should be the return on this particular cash flow? So you have invested $75 today. You're going to receive 15 every year, and at the maturity you are going to receive $115. So what is the implied return on this case? So if you invest $75, you are going to receive this. Okay. In other words, I can say that you have invested $75 in a bank and the bank is ready to pay $15 every year, and at the maturity it is paying you $115. So what is the implied interest rate provided by the bank? So that is nothing but the yield to maturity. Okay. All right. Now let's assume T% increase in the interest rate was value of our bond. Tirupati, I didn't get your question here. I mean duration of the bond. I didn't get your question, sorry. Can you please rephrase it? Harin is asking, that means junk bonds always purchase in the premium. No, Harin, that's not the case. Junk bonds would always have a higher yield, okay, because those are risky bonds, so they will have a higher yield. Coupon does not matter. The only thing that should matter is the yield to maturity. Okay, so yield to maturity gives you the indication about the return an investor would earn. Okay, can market price vary for years? What would be the Ramanath, I didn't get your question. Please rephrase it. Can market price vary for years? What would be the circumstance? Yes, correct. So we have already seen that if the time to maturity decreases, suppose here the time to maturity was say 5 years and now it has decreased to say, okay, let me change this number to say premium bond. So 116. Now if the time to maturity decreases, simply the time to maturity is decreasing. So say 4 years, the price of the bond is decreasing. Okay. Suppose 100 now, when 1% increase, then obviously our price decreases like this. How long a bond? Okay, so okay, Tirupati, I still haven't got your question. No, Ramagal, it's not very active in India. No. Ramanath, that does not matter whether you invest in par premium or discount bond. The only thing that is going to matter is the yield to maturity. Okay, so it does not matter. Okay, if coupon does not matter, then what about reinvestment risk? Okay, so okay, and the yield to maturity and the price of the bond are directly related, meaning if the price of the bond is higher, the yield to maturity is higher. That's correct, Arun, that's correct. Now Suresh is asking me, if coupon does not matter, then what about the reinvestment risk? So it's a different game altogether. So it's a different discussion. So here, whenever you're getting a coupon payment, so $10, so what is the reinvestment rate or the reinvestment income here or the reinvestment risk here? So here, when I was, suppose I have a bond trading at $113 today, okay, and the maturity is 4 and the coupon on the bond is 10%, so I can calculate the implied interest rate on this. So suppose the implied interest rate is 6%. Okay, so if the implied interest rate is 6%, okay, so here we are doing the reverse. Okay, so I know the price, I know all the characteristics of the bond, and from there I am calculating the interest, which is the yield to maturity. Okay, so that comes out to be 6%. Now here, when I get the 6%, my assumption is that all these intermediary cash flows, these are going to be reinvested at 6%. Now suppose these cash flows are not reinvested at 6%, the total return from this particular bond is going to decrease. Okay, so suppose if these cash flows are invested at say 5%, so the net return would not be 6%, that would be slightly lower amount. Okay, so I think I should run an exercise here. So guys, let us see here. So suppose the price is this, okay, so $113, and the cash flows are these. These are the cash flows. So here I am trying to calculate the IRR of this. So if you calculate the IRR, it is 6%, correct? So this 6% is nothing but this is the yield to maturity from the bond. Okay, so no matter what the price is, the only thing that this particular number defines all the numbers in the cash flows. Okay, so I'm not saying coupon is not important. My only point is, if you have to see one number from the return perspective, that number is the yield to maturity. You cannot look at simply the coupon rate and invest in a particular bond. The only number that contains everything is this yield to maturity. Okay, so which is nothing but the IRR from the cash flow problem. Okay, fine. Okay, and let me use questions here. Coupon is what? Okay, now coming to reinvestment risk. Now suppose, so here the assumption is the 6% return we are getting. Here the assumption is that these cash flows would be reinvested at the 6% rate. But suppose these cash flows are not reinvested at 6% but some other rate. Okay, so then we have a different term called as MIRR or modified IRR. So these are the values. Okay, and say my reinvestment rate is not 6% but say 4% only. Okay, then see the return is 5.76%. So this decrease in the return is nothing but the reinvestment risk. Alright, Suresh? Yes, Ramanath, there are other valuation methodologies as well. Let's imagine an investor buys at 110 and after N years the price of bond comes down to 90. Now investor thinks of selling the bond back to the issuer. So at what price he will be getting the bond? So that will depend on the price of the bond. So if the price is 90, you will sell it at 90, right, Harry? You have no other resort but to sell it at 90. If you have bought it at $100 and even tomorrow the bond price comes down to say 105, you have to sell it at 105. If two bonds are having the same yield but different coupons, then which one an investor should consider? They should be indifferent, Suresh. They should be indifferent because the price would be different. Why we are considering only yield to maturity? Because I'm saying that yield to maturity gives you, this is one number that gives you the return from the bond. Okay, so this is the simple cash flow problem. If the price is $114 in the market and these are the cash flows that the bond will give you, the implied return is 6%. Okay. I think I missed one question. Can you please write it again? If issuer buys back from reinvestment, then at what rate they will pay to the investor, at the face value or the rate at which investor bought the bond. What if issuer buys back for reinvestment? So then Harin, then it's not that simple. I think you're talking about callable bonds. Okay, so it's not. So then you have something like a call price as well. Okay, let's not get into that. What is the strategy to be adopted? What is the strategy to be adopted under a high raising inflation scenario? A strategy to be adopted under a high raising inflation scenario. Ram Gopal, I didn't get your question. What is the strategy to be adopted? Ramanath, that would not be the case, okay, normally. But even if that is the case, you can find the price very easily. Correct? So even this particular template will give you the price of the bond. Guys, any more questions? The high coupon may be deceiving as the value at the end of the tenure would be very less. That's correct, Ramgal. That's my point. So my point was you should not look only at the coupon. Okay. Ramanath, you need to write a mail to Zainab at EduPristine. Okay, please write a mail to Zainab at EduPristine. Any more questions? Is the pricing of structured notes similar to the bonds, the only apparent change being the nomenclature and the securitization? Yes, Shiva, in general, see the methodology is going to be the same though, but in structure products, how to get the cash flows and how to model the cash flow payments, that's the only problem. Okay, so as I told you in the beginning, any valuation would always consist of three parts. Okay, cash flow, expectation, and the time value. Now, if you are able to model cash flows properly, then you get the valuation. The only problem that you are going to face in the structure products is modeling the cash flows. Okay, so if you are able to model the cash flows properly, everything else is just the same. Does this kind of valuation be continued on the periodical basis even after investment decision? See, finally, suppose a particular bond investor has invested at this particular rate. So the only thing that is going to change this price is the yield, or say the market interest rate. So if the market interest rates goes up, the price is going to go down, right? So then people don't look at these cash flows, but they keep on looking at what point they should sell or buy these bonds. Okay, so if they expect the yield to maturity to go up in the future, they will buy it in the future. If they expect that yield to or say market interest is going to go down, they will buy it today and sell tomorrow because the prices are going to go up tomorrow. Okay, so then it's just a game of price and the interest rate in the market. coupon payment flag. Okay, I'll come to it. You can, okay. Explain again the maturity of the bond flag. Okay, I'll come to it, Ramanath. What will the change in the approach so far in the case of floating rate bonds to arrive at the yield to maturity? See, Shiva, in the floating rate bonds, one thing you need to remember is that every point when the coupon for next year is decided, the price is nothing but the face value of the bond. Okay, so the price of the bond only changes between the period when the right. So in the case of floating rate bond, the price is going to change from the face value to face value between two coupon paying periods. So suppose this is the coupon paying period, this is the coupon paying period. So the price here would be nothing but the face value. Similarly, here is nothing but the face value. So prices are going to change only at this point. Okay, now coming to these flags. See, guys, the purpose of these flags were just to explain or build this model slightly flexible. Okay, so here coupon payment flag is nothing but true or false. Okay, a flag is nothing but a true or false. So here what I wanted was that when the tenure is 4, I get the coupon payments only till 4. Okay, so one way could have been, I could have written if this year, this particular year is less than, say, less than equal to the tenure of the bond, give me the coupon payments, otherwise give me 0. So this is one if statement that I could have written, right? And for the face value of the bond, I could have written if this year is equal to the tenure, give me notional value, otherwise give me 0. This is the other way, right? Or instead of writing an if statement here only, I could have built a flag here. So which simply tells us that if this year is less than tenure, give us 1, okay, or give us true or false. So this is true or false. Okay. So here why I am multiplying it with 1 is that true and false is nothing but a boolean. Okay, so true is equivalent to 1, false is equivalent to 0. But when you sum these trues, you will not, so suppose I sum 4 trues, I will not get, say, 5. Okay, I will not get a numerical value. Okay, so that's why I multiply it with 1 to convert this boolean into a numerical value. Okay, or I could have written a if statement as well. So if this is true, give me 1, otherwise give me 0. Okay, so it is just to get the right coupon payment under the right year. Got it, Tirupati? Ramanath? Okay, great. Tirupati? Okay guys, so if you have no more questions, let's wind up this session. Thanks for listening, and I will ask somebody to send this filled workbooks. Thanks a lot, guys. Thank you. I'm sending this. Excel workbooks to one of my colleagues, and they will send you this Excel workbook as well as the notes that I've written here. Thanks again, guys. See you in the next session. Bye.
The organizer